with Gayle Stanley.
Hi.
And Jorey Blackmer from Mid-Florida Professional Mortgage. Hi, Jorey. Thanks for being on today.
Hey, what's going on, Victoria? It's great to see you and Gayle again.
Good to see you too. Well, we are wanting to address some things that have been on a lot of people's mind about how has COVID-19 affected mortgages for our buyers. Do you mind telling us a little bit more about those changes?
Yeah, definitely. COVID-19 has had a couple of changes come with it, mainly just because it's brought a lot of uncertainty with, mainly people's jobs. So some of the things that people would really like to know about, and one of the biggest questions that people have are, how has it affected the interest rates, and how has it affected my qualification? So when it comes to interest rates, COVID-19 hasn't really made a big difference in interest rates. We're still seeing remarkably low interest rates. We're seeing stuff down in the threes, low threes, mid threes, high threes. And it's mainly for conventional. Now, how it has affected interest rates is really for the FHA buyers and for government loans in general. Now, what government loans are, anything FHA, VA, and USDA. The reason why it's affected those is just, it's on the back end of loans, but basically they're not as attractive to lenders to do as conventional are. So you have seen the interest rates go up a little bit on those government loans, especially with people who are under a 700 credit score. Now, the second question that comes in is, how has COVID-19 affected my qualifications? Can I still qualify for my property, or can I still qualify for a home in general? And that question is, yeah, you can totally qualify, but there are extra steps that the lender is going to do to ensure that this loan is 100% secure. So one thing that we've really seen change is credit score qualifications. Credit scores for all government loans used to go down to 580 for some lenders. Other lenders wouldn't do that, but they used to be 580. Now we're seeing credit scores, the minimum requirement is to 640 and 660. So those government loans are harder to qualify for. And remember, government is FHA, VA, and USDA. Conventional is still a 620. And another thing that has severely changed on that is your debt to income ratios. Now, government loans used to be extremely lenient, meaning that they were easier to be approved for because they had higher debt to income ratio qualifications. You could go up to 55% with FHA. You could go sometimes, depending on the client, 60% with VA. Now everything is capped off at 50%. So you do have to have lower debt to income ratios. We are seeing clients needing better credit scores. And really the biggest thing is that they're doing in late is checking verifications of employment many times during the transaction. They want to ensure that your employment has not changed from the point that you've started the contract to the point that you're closing. So those are some of the things that we've seen change.
Jorey, what if someone has lost their job for part of the time between contract and close? How does that impact it?
Yeah, that's a great question. So if the individual, let's just say that when we started the contract, they had a job, and throughout the transaction, they've either lost their job or their pay has been deducted by some percentage, the lender will find that out through, and this has happened personally through many loans that we've recently done during COVID-19. So what has happened to those clientele is, if they've lost their job, the lender or us will try to figure out, is there a time frame that this individual is going to be going back to work? Is this just a furlough type of thing? Or is this, hey, we really don't know the time frame of this? If we have no idea of what the time frame is, we kind of have to put that loan aside and say we can't really work on this because you can't get a job or you can't get a loan without income. But if there's a time frame, we typically like to, there's a time frame, we will work to get that done. Now, when it comes to the percentage, so let's just say that there's an individual that's making $100,000 a year and they had a 25% pay decrease. So now their income is at $75,000. The lender will now use that $75,000, even though the employer is saying this is going to be temporary, this is just due to COVID-19, their income will go back up, the lender is not going to take any chances on it. They're going to use the lower income.
Wow, that's significant.
Yeah, that's great. Jorey, thank you so much for answering these changes during COVID-19. I know this will help a lot of people who are interested in buying, and also letting them know that you're still pre-approving people to get loans to buy houses right now. So that's awesome. Thank you so much.
Yeah, not a problem.
Okay. Have a great day.
You too.
Bye.